They survived the Great Depression, the dot-com bust, and the 2008 meltdown. How do mutual insurance companies just keep on winning? Stick around. That's what we're talking about today.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And like we said earlier, what we're going to be talking about today is how mutual insurance companies have weathered every major financial storm since the Great Depression. I can't wait. This is going to be a great episode. What do you think, Faso?
I'm looking forward to it. And, this started when I had met with a client. We had went through the education process, talked about we're going to use a policy to expand for her to buy more real estate. And then she heard of a risk the U.S. is going to come into a recession and had some concerns of storing her money in a policy as opposed to storing it in a bank. And so based on that, Cameron and I, we talked. I'm sure there's other people besides her who have those same concerns. So why don't we do our research and present it as a podcast?
Well said. So today what we're going to be talking about is we're going to walk you guys through 100 years of history to show you how mutual insurance companies have withstood some of this financial uncertainty, even when banks and other financial institutions have really failed. So Anthony, let's get going, man. Tell us why.
Well, let's talk about why this is important. And if you're using the infinite banking concept, we're storing a policy that, again, this is going to be designed for high cash value. This is going to be your financial foundation. This is where the liquidity lives. This is where we're storing our capital, and then we borrow against it to either finance assets or to finance liabilities. But however, none of that is going to happen if the insurance company we're storing the money becomes insolvent during these difficult times.
Absolutely. Right. We've seen banks fail. We've seen Wall Street melt down, even big name institutions go belly up. But oftentimes people forget, and I think maybe even more often people don't realize mutual life insurance companies have been the tortoise in the race. They are not flashy, but they are definitely reliable. And that's why understanding the history in downturns is going to be so important for us today. So let's break down this recession by recession, starting with all the way back to the Great Depression. Well, if you go back and look at the Great Depression, there were over 4,000 banks that failed, and only a handful, just a few mutual life insurance companies actually went under. And from the research that I did, every policyholder was made whole, and thanks to the conservative investing and strong reserves from mutual insurance companies. And so what happened is even if one of them went under, there were other insurance companies there with plenty of reserves to come in, make that policy owner whole, and really just absorb them under their new umbrella.
Cameron, how many banks did you say failed?
Over 4,000.
4,000. Now, we got to remember, this was literally almost 100 years ago. I mean, 4,000 banks sounds like a lot right now. But I imagine we have a lot more banks now than we did 100 years ago. So I think that 4,000 number, we put that in time perspective, is a huge number.
Yeah.
But then, if we jump to the 1970s and 80s, this is when we had stagflation, high interest rates, and particularly stock insurers started to wobble. However, mutual insurance companies still thrived, still paid dividends. And one way they did it is they created new products. This is when universal life and some variable life products were created. So a couple of things I want to talk about of the 1970s and 80s. For one, the insurance companies making new products, they did it for twofold. For one, because interest rates were so high, which I'm going to talk about, they wanted to compete. So they had to do a different product that was somehow tied, that had some, that they couldn't rely on a guarantee. But what that really did is that took the risk, or the risk of the policy's performance away from the insurance company and then on to the policy holder. Because when we have a whole life policy, there's guarantees in there that the insurance company must meet. So the risk is on them. On these variable products, it's up to the market, and the insurance company does not have to guarantee it. So that shifts the burden from the insurance company to the policy holder. And when I was doing my research during here, very interesting when we talk about high interest rates, particularly mortgage rates. Like, what I find interesting, everybody's concerned about how high mortgage rates are, where it's approaching 7%, but Cameron, do you know what the average rate was in the 70s?
I don't. I'm going to guess. I'm going to say 6.5.
Well, too low. 1970, it was 7.3 and went up every single year. 1979, 11.2.
Wow.
Could you imagine getting a mortgage for 11.2 when
Well,
people are complaining when it's half that rate? Now, that was the 70s. It started creeping up in the 80s. It got as high up to 16.6. But again, the important thing, what we're talking about here, is how do the insurance companies perform? And really, the insurance companies, a lot of what they invest in is interest rate sensitive. So when interest rates are high, that's good for mutual insurance companies. So again, like one thing we're going to talk about, insurance companies are built for these times, like the recessions.
Well said, Faso. Guys, if we fast forward to 2008, the great financial crisis, the comment I want to make was how soon we forget, right? Faso, you're talking about the rates in the 70s and 80s. There's really, right? I didn't experience that. I was born in the 80s, right? And so I think when we see rates that are at 6, 7, 8%, everybody freaks out. And so a little bit of understanding history certainly helps out there. If we jump fast forward to 2008, we look at the great financial crisis. Again, one of the big indicators there is the failure rate between banks and mutual insurance companies. And again, it's absolutely night and day. The stat that I found was that there was almost 500. There's 499 banks that failed in 2008. And Faso, I know you know this number. How many mutual insurance companies failed during the Great Recession?
Same number of hairs you have out of place. 0.
No one failed. And in fact, the mutual insurance companies continued to pay dividends. And those dividends that were paid out were in the billions. We've done several podcasts on that, talking about dividends, what makes them up, and the amount of money that they're paying out. So I'm going to urge you guys to go back and listen to those.
Now, one thing that was very interesting during that time, that the bond rating agencies actually downgraded the United States, which made huge news. But you know what didn't make huge news is there was at least one mutual insurance company, One America, that actually had an increase in their rating during that time. Now, to me, if you kind of step back and look at it, everybody else's rating is going down, but people in some industries actually going up. Again, it's just reinforcing that we have a sound foundation when we're using a mutual insurance company. And then the next kind of recession we're going to, or we're going to talk about, is during the lockdown and during COVID. Record high death claims. Now, however, mutual insurance companies remain solvent. They did adjust their dividends slightly. And the important thing is they continued to pay dividends during that time. During that time, their largest expense, which is death claims, had the highest increase in over 100 years. The last time there was such a large increase in death claims was the Spanish flu or the pandemic of 1917. How many companies that, if their largest expense takes the largest increase in 100 years, and they can still make money that year? I'm not aware of any, but outside of a mutual insurance company.
Do you want to increase your returns and lower your taxes? Well, that's exactly what the infinite banking concept can do. This is a game changer, and we can show you how it works.
Book your free call with us and learn how to build wealth the smart way. Stop procrastinating. Go schedule a call now. The link is in the show notes. Well said. Faso, one of the things I looked up was that dividend that was paid kind of around COVID. And what I found was interesting was I looked at Penn Mutual and Lafayette's. In 2019, Penn Mutual's dividend was 6.1. In 2020, 6.1. In 2021, as you mentioned, they did slightly decrease it to 5.75, and it stayed there to 2004 when they brought it back up to 6.0. Compare that Lafayette. Lafayette was at 5.2, not only in 2019, but in 2020, 2021, 22, 23, and then they increased theirs in 2024. Again, guys, don't put too much emphasis on the dividend rate, but a dividend rate is a great indicator of financial resilience, right? And so, again, you see a minor change to a dividend rate, again, with such a huge impact that we went through with COVID and just this economic shutdown. But insurance companies, financially stable, it was a small blip on their radar, and they just continue to do business as usual. Guys, if you compare kind of the way that insurance companies, mutual insurance companies are able to handle kind of those types of recessions, and you compare it with AIG, Lehman Brothers, or even your local bank, and the picture becomes very clear is that mutual insurance companies are built for times like these, right? Is they are the foundation when it's volatile out there. So, Anthony, how are mutual insurance companies able to do this?
I tell you, I broke it down to three key reasons. The first one is that they invest primarily in long-term, high-quality bonds. Now, I don't know, Cameron, if you caught it, but Jamie Dimon, the CEO of Chase, spoke last week saying that the bond market was due to be cracked. I don't know exactly how he phrased it, but whether he's right or wrong, that's not going to affect the way the insurance companies do it. Because what he's talking about is that he's thinking that there could be some loss of liquidity where people might be less apt to buy some of these bonds. And that's particularly is if you want to sell it, right? Or if you're trading bonds, then you do have to, it can be a volatile market. But however, they're not trading bonds. I'm talking about mutual insurance companies. They're buy and holding bonds. They buy a 30-year bond. They hold it for 30 years. And then when that bond is up, they buy another one. So that's why they have that long-term view, which can eventually will even out all the ups and downs in the interest rate market. Another reason is they build massive reserves. They're sitting on a ton of liquidity, which can do many things. For one, when expenses rise, like there's death claims you didn't expect, they have the liquidity to pay it. But also, they have the liquidity to buy assets when they are on sale. And I think that happened quite a bit in 2008. But sometimes the real estate market will go in and buy, mutual companies will go in and buy real estate. And there was a lot of real estate on sale of 2008. Like we all know, whenever there's a recession, that's a buying opportunity. But only for people who have liquidity. And that's one of the things that the insurance companies do that allow them to excel during times of the recessions. A third option, insurance companies don't have shareholders. They're not traded on the stock market. They're not tempted to make short-term decisions to prop up their stock price. They're owned by policyholders. So they have a long-term view and which allows them to make long-term decisions and not be tempted to make short-term decisions that could have a long-term cost.
Well said, Faso. So what I heard you say there is, one is buy quality assets.
Mhm.
Two is have massive reserves. And then three is don't be short-sighted, be patient. That sounds like great advice for us at the individual level, right?
Yeah.
Yeah. The other thing that I would add to that as to why mutual insurance companies are so strong is because the regulation that they have is mutual insurance companies are state regulated as opposed to banks are federally regulated. And banks are able to do things that insurance companies are not. And that's not a good thing. Banks, what they do is they actually practice what's called fractional reserve banking, where we've talked about this in our interviews with Barry James Dyke. If I go down to the bank and I put $1 on deposit, banks literally can lend out as much money as they would like in loans. Insurance companies do not have that ability, right? So they're state regulated. We put $1 on deposit, and they're making these types of sound investments that Anthony just outlined. So when you look at the financial stability when wondering why, the reasons that Anthony just outlined, and because of that ability to leverage that banks have, that insurance companies simply don't do, that's why they're so financially sound.
And, Cameron, just to reiterate what you said, that's why they perform well during the recessions. When banks are using that fractional reserve banking, when things are good, things are really good because everything's amplified. But then when things are bad, they can be really bad. But banks are not allowed to do that type of trading. Cameron, another thing is particularly, the insurance companies we use, all of them are 100 years or older, which means they have experience. So they learn from from every crisis. In fact, after the 80s, they implemented risk-based rules. And then after 2008, they have stress-tested annuity guarantees. And then after COVID, they integrated pandemic stress tests. So every time something happens, they learn from experience.
Well said. Those types of experience and those qualities that we just outlined, that's what makes mutual insurance companies uniquely reliable, which is exactly the type of foundation that we are looking for when we make recommendations as a place to keep cash while you guys are practicing the infinite banking concept. So now what you guys should do, right? If you guys are out there and you guys are using infinite banking, hopefully this will give you a little bit of confidence that you're partnered with one of these time-tested institutions that is out there that is practicing this type to make sure that your money is safe and sound.
And also, we've said many times, and I firmly believe the safest place to store your capital is inside a mutual insurance company. And I know a lot of people will look at banks and rely on the FDIC. Cameron, you grade some great data where these banks have failed during these recessions, and mutual insurance companies have thrived. Mm-hmm. And we can even do a whole podcast on the reality of the FDIC. And we didn't even touch on, when that last crash happened, even I think you said almost 400 banks failed. So not even 4,000, only 10% of that. But that 10% wiped out all of the reserves of the FDIC. So you know who paid for it? You and me, the taxpayers, right? And the government had said, we're not going to bail you out again. They called it a bail-in. I don't want to go. I didn't mean to go down that rabbit hole, but the bottom line is, even with the FDIC, your money is still at risk at these banks. And hopefully we've shown why and how the mutual insurance companies are the perfect place to store your liquidity.
Well said. I love your last point. My last point would be this, is that typically when you're looking at the way that banks will perform in a crisis, is there's failures left and right. We just outlined that over the years, and you compare that with mutual insurance companies. Typically, the worst thing that's going to happen is they're going to lower your dividend a little bit. And if you compare those two, it's completely night and day. But the point that I always share with clients is that they might lower your dividend, but they never stop paying a dividend, right? And they pay it by the billions. And so, again, we hope you guys rest assured. If you guys are listening, right, and you guys are wondering kind of what to do next steps, feel free to reach out to us. We'd love to sit down and talk about some of this more in detail, how it might pertain to you guys. And again, if you guys are looking at taking your next step in infinite banking, feel free to reach out to us. Anthony and myself would love to jump on a call with you.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.